markets are looking for a better economic growth and better earnings, but yet yield curves, leading indicators, economic indicators across the board all suggest that a recession is still coming. So who's right? Here's what you need to know before the bell. Markets yesterday started off a little bit weak and then opened up and went rallying pretty strongly into about midday and then completely sold off about midday. And even though the markets ended flat yesterday, the markets actually were slightly positive on the day from where they opened. So we have a green candle here. But again, really coming off that 20-day moving average, that support level holding. This morning, futures are looking to point higher. Nasdaq's up about 50 points, Dow's up about 100 points right now. So again, futures are suggesting markets are going to open up, a little bit stronger this morning. We'll see if this 20-day moving average can hold. The threat here, and I shouldn't say the threat, but the issue is, of course, we still have 2 days left for portfolio rebalancing to get us through the end of the first half of the year. So again, how we open up this morning and how we end can be two very different things. But right now, we're still on this sell signal. That's the thing to keep paying attention to. Historically, what that suggests, it doesn't mean that prices, and when you're on a sell signal, it doesn't mean prices have to decline sharply. As we saw back earlier this year, we spent a very long time on a sell signal that basically the market just literally went nowhere. So markets can either consolidate or they can decline, and that's what this sell signal is suggesting, is that upside's probably fairly limited right now. We might have 100 points of upside, but the risk is, as we head into later this summer, is we've got about 200 to 300 points of downside. So the risk reward in the market right now really isn't there. And if we do get a correction, 5 to 10, as we've said before, 5 to 10% corrections are completely normal within any given year. We've had a year of exceptionally low volatility, as we were discussing yesterday. And so a correction of 5 to 10% here would not be surprising at all, and that would actually give you a much better risk-reward entry point for that kind of end-of-the-year push that you typically get from October to December. So some type of corrective action this summer should be expected. Doesn't mean it has to happen. We've had years where markets have had no correction at all, basically. I mean, the worst correction we had was maybe 1 or 2%. But there is a risk here of a bit of a correction this summer as kind of this exuberance in the market starts to have to align with earnings season. And that's what could be the trigger here. Now, over the course of the next couple of weeks, we're going to get back into earnings season. Apple, Microsoft, Facebook, they've got high benchmarks now in terms of their hurdle rate for those earnings. So keep a watch on that. That could be the trigger. But that's the thing to keep a watch on. So that's what you need to know before the bell this morning.